This line chart tracks PayPal's multi-year share price, documenting a steep decline from pandemic highs down to the $50 range in 2026. Wall Street's pessimism centers on two numbers. Active user growth stalled at 439 million, and top-line revenue growth decelerated from 20 to 4.3%. But step away from the stock ticker and look at the physical scale of the underlying business. In 2025, PayPal processed a record-breaking $1.79 trillion in total payment volume. This dual-axis chart reveals the magnitude of the disconnect. While the share price plummeted, the company quietly generated $6.4 billion in adjusted free cash flow during that same period. On the floor of the New York Stock Exchange, sentiment often outpaces math. This setup, a hated stock attached to a highly profitable, cash-generating business, is the classic signature of a deep value mispricing. To find out if this is a dangerous value trap or the bargain of the decade, we have to run an objective audit. Phase 1 of our stress test filters the company through core valuation multiples and balance sheet strength. This gauge shows PayPal's current price-to-earnings ratio dropping deeply into the green. At 9.3, it sits at a 10-year low, far below the traditional value investing standard of 15. The balance sheet provides a safety net for that valuation. The company carries a debt-to-equity ratio of 0.49 and covers its debt obligations 14 times over with its annual operating income. The math suggests the stock is cheap and the company is solvent. However, financial safety alone doesn't protect you from permanent structural risks to the business model. The market is watching two major structural threats: competition from Apple Pay and the potential rise of AI-driven agentic shopping. In this scenario, automated AI assistants process purchases through direct data connections, making traditional consumer-facing checkout buttons irrelevant. To counter this, the board installed Enrique Lores, an executive tasked with restructuring the company's operating model and integrating biometric security into its core infrastructure. Lores has shifted the strategy away from expensive customer acquisition. Instead, management is now focused on extracting deeper monetization from the existing base of 439 million accounts. The first piece of this overhaul is Fastlane, a modernized guest checkout solution built to match the speed and convenience of one-click rivals. This funnel chart demonstrates the core of the margin strategy. By pushing biometric authentication, which currently stands at 36%, with a target of 50% by the end of 2026, they can significantly increase the checkout inversion rate for merchants. A mature digital utility doesn't need to add millions of new users every quarter if it can increase the completion rate and margin on the billions of transactions it already processes. The final phase of our stress test looks at how management allocates the cash they generate. Watch this circle graph representing PayPal's outstanding shares. In 2025, the company spent $6 billion buying back stock, retiring 7% of the float. Advancing the timeline from 2022 shows the cumulative effect. They have systematically erased nearly 21% of all outstanding shares. They also introduced a 14-cent quarterly dividend, signaling a new phase as a mature, shareholder-focused business. By shrinking the supply of stocks so drastically, management is manufacturing higher per-share value, even while overall revenue growth remains moderate. To find the exact margin of safety, we run that $6.4 billion free cash flow baseline through a discounted cash flow model. Assuming a pessimistic case of zero cash flow growth for a decade, intrinsic value calculates to $73 per share, leaving a substantial safety gap to the $50 market price. Angling the projection upward for a 7.5% recovery, the target climbs over $125. The market is currently pricing PayPal as a business in terminal decline, ignoring its core cash-generating power. The evidence suggests that PayPal is now a mature digital utility, a specialized layer of financial plumbing that prioritizes transaction efficiency over user acquisition. At its current suppressed valuation, this creates a massive 12.1% owner's earnings yield. To run your own stress tests and access our raw financial models, visit deepvalues.ai and download the Buffett Indicator app on iOS to track total market temperature. Subscribe to the Deep Values sister channel for more life and investing philosophy, and leave a like if this audit helped your research.